Hey guys, welcome back. In today's video, we are talking about the shorts in need, the low shares to borrow, the share buybacks, and many more in this video. First, we're taking a look at this. There is no way Citi's analyst who put AMC price target at $1 didn't know what was coming for the box office in 2026 and 2027. And it became so clear that those price targets are nothing but a psyop to affect retail investor sentiment and views about the stock future performance. So we've always talked about this in terms of some of the price targets that are given out by these institutions aren't based on any, at least to me, statistical facts, but rather based on what benefits them. Now, for a company like Citi, who we know in the past before has had affiliation with AMC shorts, we're talking about the Brazilian ADR shares, so the offshore synthetics. We talked about how they're constantly the counterparty for AMC shares as well. And so when you include all of these things together, you start to realize that they have a benefit with the fact of AMC price going down. Because why else would they give AMC a price target of $1, especially when you realize what was happening to the box office in 2026 and what's obviously going to propel into the future of 2027, as we're already seeing how well we are doing. And so this is what we said with how they're using it to affect retail investors' sentiment. Now, the key word here that I want to talk about, and again, I'm not sure to other people, but I want to talk about retail investors. And there's a very key word there because it's different from apes. Apes already know where AMC should be going. Apes know how well AMC is doing. If I ask an ape in terms of what do you understand about the box office, what do you understand about AMC fundamentals, they will know exactly what's going on. And then when we talk about, what do you know about the dark pool, what do you know about the suppression, I'm sure that 99% of apes will know what's going on with AMC. But the difference is that for retail investors, for some people who may want to get exposure within the industry, the theater industry, and you're looking up at who's the biggest market share company in the industry, you then take a look at AMC. But the news that you'll be seeing, if you're not someone who's deep dived into AMC, if you're not someone who's been here for a very long time, the news articles you will see on AMC will be things like this: $1 price targets, AMC going to bankruptcy, people don't stay away from AMC shares, sell your AMC shares. That's the sort of news articles that retail investors who are new to the industry, who wants to get exposure to the industries, are seeing. And this is what we said with how they're constantly trying to do this, because they're trying to sway any new sentiment, any new buy volume into AMC, and it's why they're giving a $1 price target, because we're already seeing here that even films like this, Backrooms, which are overperforming again and is posting the highest grossing Monday of all time for an R-rated horror film in Doom. And so this is what we said. We don't need any franchise movies, sequel movies like we've seen before in the past to do extremely well. Even new movies like this are able to perform and yield extremely good results. And people should be realizing this by now. We definitely already should see a kind of alteration on the price target of AMC, because before they may still have their questions about AMC, but now when we talk about how well the box office is doing, how well AMC is doing, it is incredibly weird that they are still giving AMC a $1 price target. But at the end of the day, we know that they're not giving AMC a $1 price target because they think that the fundamental deserves $1, that they think the future projection growth deserves $1. The reason why they want to give AMC a $1 price target is because they know that if they can't force people to sell, if they can't do anything to get people to sell, then they're going to have to pay back tens, hundreds of billions of dollars to buy back AMC shares. Now, we're also seeing out here as well, another big thing is that the moment our AMC CEO bought 250,000 shares with his own money, that was the signal. And what I want to talk about is that since Adam Aaron have obviously talked about this piece of news, we've been looking at AMC doing extremely well. We've seen AMC having stayed as well, 22% we saw on the Monday. We've seen some decline right now. Again, this is something we talked about that you should be expecting, because when it goes to any other companies, you're going to be seeing them ride the momentum. But when it comes to AMC, you have to remember what this 22% means for the short sellers, especially for the short sellers who doubled down back in 0.93, who kind of bought more all the way back here. You have to remember the position that they are in right now. So we have to also see from this as well, is that because of the current suppression on AMC, we should be expecting tons of FTDs being used. But at the end of the day, you got to remember FTDs are absolutely not free. It costs them money to do so. It costs them money to try and hide it. Yes, we've seen them hide it. It's not to say that because it's FTDs, we're going to see them go bankrupt, but we've seen how firstly, we are able to expose the use of FTDs, but secondly, the illiquidity issues that will be caused when they are extremely expanding on the FTDs of AMC. So the very fact that we are seeing them trying to use FTDs right now, the fact we're seeing the suppression, it already talks a lot about what's going on. Now, you can see here, we're talking about shorts suffering and sweating. Now, what this is referring to is John Hampton, who we know is a short seller of AMC, but he talked about AMC in this. AMC is down 42% over the past year. It's amazing how many apes think I'm suffering. My biggest problem is that I did not short more. The position is tiny. So what's funny about this is the fact that back at 0.93, back when we saw AMC kind of at this low, John Hampton was talking about how since then, AMC is going to go all the way down to 0.5. So one can assume that he was doubling down on his short position. He was heavy on his short position. Bear in mind, since him talking about AMC going back down to 0.5, we've seen not only AMC have this obviously massive ramp up with over 100%, we then see it go all the way up to that 2.22 as well. And so the fact that he's trying to say his biggest problem is not shorting more, it really feels like he's trying to hide what is actually going on, because we knew that he had a massive short interest on AMC when it was 0.93. So the fact that since then AMC has gone up over 100% and it looked like he doubled down, realistically he is losing money. And to me, it feels like that is what he's actually doing. He's obviously trying to cover it by saying it's down 42%, but what little is he saying about the short positions that he took up recently, that has obviously gone deep into the red for him. And so once again, we're seeing how short sellers are lying about their positions, are trying to kind of go away from the truth when we know that in fact that they are losing tons of money. Another thing that you can look at is GME as well. Almost 1 million shares of GME were shorted at the open today, more than shares available to borrow. So at times like this, we're also seeing GME being faced with pressure. This is what we said with right now. When you're seeing AMC run, when you're seeing GME run, you start to see the whole world panic. You start to see how this firm has margin requirements, that firm is facing illiquidity issues. That's because all of the money is tied up within AMC and GME. That's so when we do see the two stocks run, you are going to be seeing problems happening. Now, these problems aren't our problems, nor are they problems that negatively affect us, but for the short sellers, it's obviously something that is extremely worrying. And it's why we're seeing this happening right now. The fact that we're seeing so much shares being shorted. And we can see here, in case you're wondering, GameStop just reached the lowest availability of shares to short in 12 months. Another showcase of how the demand suddenly goes up for AMC, for GME, the moment we start to see their price go up. You can see the coincidence as well. Now, obviously, GME has had some positive news, but the same applies for AMC. But also, it's the fact that we know that these news technically won't have a big effect, because should they have effect, they would have done so already. What we are seeing is just the illiquidity problems that these short sellers are having. Now, AMC, GME is already extremely undervalued. If we are talking about the real fundamental value, we're easily seeing how AMC GME is going way above than its current price. And so to me, when we see the stocks go up and people are trying to cling it onto the fact that it's because of news, yes, there is a percentage of that. But the fact that if it really is news causing AMC and GME to run, then we should have ran a long time ago because of how well we are doing. Because you can see here from GME, record quarterly net income. 389.6 million versus the 44.8 million last year. Record Q1 operating income of 143 million. Net sales of 835 million plus 14% year on year, and cash investments at 9.7, whilst the board has approved a $2 billion share repurchase program. So if you want to talk about AMC and GME doing well, this is what we're looking at. We've already seen how well AMC is done for Q1. We're now seeing how well GME is doing for Q1, and obviously a very big news on the share buybacks as well. If you want to take a look at kind of a visual image of how well GME is doing, this is what you're seeing. So this is how we said that GME and AMC should have already been up ages ago, because you can see how well GME has improved since the Q2 of 24 going onwards. And, you know, this is what we talked about with how if news really did affect AMC and GME, we should have seen them run ages ago. Right now, what we are seeing is the problem that these shorts are facing. Another big thing, and is why we're suddenly seeing them trying to suppress GME as much as possible, is what a share buyback truly means. Because a $2 billion share buyback for GME, what we can see is that the mechanics will push the share price to $32. Now, the 2025 warrant, it had a strike price of $32, which means that it would trigger 59 million warrant shares that can be exercised. And this is how we're talking about how GME will destroy the short sellers. You can see how this is all a checkmate move, really. We can see the momentum kind of going on from here. We can see how this is going to snowball into a massive effect. And so when we talk about how are the short sellers worried? Are the short sellers panicking? Yes, they are. And this is why we're suddenly seeing all of these short sellers starting to need money. I'm wondering why they will need that much money. Maybe it's because of the toxic swap on their short position in GME. Well, we recently talked about how Citadel seeks to extend and upsize this $4 billion loan. And again, this is off the back of them posting record profits. Why would a company that is doing extremely well, that is make record profits, need to borrow more money? The answer probably is that they're not doing well, they're underwater on positions that they are not discussing. And that's what we're seeing. You can also see here another showcase of how Citadel is not doing well is the fact that we saw how they were ruled against Citadel Securities upholding the SEC's position that the firm's highest frequency trading practice involve exploitative tactics that drain more than $5 billion per year from individual investors. Now, firstly, you can already see the fact that we are seeing this being talked, you should see the sort of company that Citadel is. But secondly, is to talk about how we are now potentially seeing some major changes within the industry, and that obviously is good for us. Also, you can see, imagine being short on these two companies alone, them both having record-breaking quarters, yet we are just dumb money. So we are now seeing how the short sellers who are always calling out investors of AMC and GME to kind of finally see what it means to be the real dumb money, because they're shorting on two companies that are doing well, extremely fundamentally well. And the only thing that they can do right now is to use exploitative tactics, illegal tactics, to really manipulate the price, as opposed to actually using the fundamentals of a company to judge whether or not it's going to go up or down. You're also seeing here with the changes to the audit system. So this is still talking about the CAT system, and they're trying to right now consider whether or not changes should be made. So we've been seeing recently a lot of thoughts on the CAT system, where we're seeing them trying to remove certain data, trying to remove certain requirements, trying to remove certain boundaries. And it just feels like they're trying to decrease the transparency that the CAT system was once promised to give. And it really begs the question of why they would do so. Now, yes, earlier I did just say that potentially we are seeing some changes within the industry, and that's because they're ruling against Citadel in cases like this. But the fact that they're still overall not trying to make the CAT system as transparent as possible, it then really feels like they're contradicting what they're doing. But this is something we're still yet to see on what they will do. So it's something we need to keep a close eye to. Now, for some apes, maybe you're interested about HYMC. Now, it's important on two ends because firstly, AMC still owns HYMC shares. So it directly affects the investment, the fundamentals of AMC. But also some apes have bought into HYMC as well. When we take a look at this right now, HYMC is doing extremely well. We're seeing how well and how strong they are right now. When you take a look at what biotech has said, you can understand exactly where we are at. Not only that, the average kind of price targets for HYMC is in the hundreds on MarketWatch. And so we can see really the positive effects that there is. Another big thing recently, Hubsy, which traded this float 1,110 times. Now, during that time, it was a 30.33 stock. We saw another 158.7 million shares sold short today, and it jumped more than double to 0.66. So again, it's just another showcase of what happens of when a stock is overly traded and you're seeing the kind of the shorts being margin called and you're seeing the price exploding. A big thing, 420 billion wiped out from the US market. Now, in comparison to how much it has grown recently, it's not something that is major, at least in my opinion. But this is something to talk about when there is mass volatility like this. You tend to see some funds to get caught out because they are over leveraged. So if we're constantly seeing news like this, it wouldn't be a surprise to me if there are firms that are facing margin calls because of the over leverage that they have. We're also seeing how a potential market shape hedge funds could trigger a spike in your loan and mortgage rates overnight. So this is what we talked about with, there are so many problems right now in the market that's everywhere. And we don't know which one is going to trigger. We don't know which one is going to explode. What we do know is that when it does explode, it's going to cause a massive earthquake within the whole industry. Not just one market will be affected, but everyone. And that's when we'll see AMC and GME thrive. Another big thing, yen again at 160, the USD against Japanese yen. Once again, potentially seeing the government intervention again, but it will come to a point where if government intervention no longer works on the yen, then that's when we'll see the market crumble. As always, know this is financial advice, and I'll catch you guys next time.